A big shake-up at UBS's $2.3 trillion wealth management division. Earlier, I sat down with UBS Chairman Axel Weber. Here's what he had to say about the wealth management business, which is driving the business at UBS.
The quarter has been good for us, and of course, in addition to the front-loaded impact of the U.S. Tax reforms, which produced the write-down of our DTAs, the business has been growing steadily. We've had record values of net new money in the bank. Our wealth management business is doing fine. We've gone through the transformation of the wealth management business over a number of years now, and we're very strong in Americas in the business. We're very strong globally, and that's where we decided we would start integrating back offices, for example, and we will move to a co-head structure of our global wealth management business.
So let's talk about tax reform. You mentioned it a moment ago. The law taking place now this year. What kind of an impact have you seen?
Well, so we're expecting a good 0.5% impact on U.S. growth this year and next year. And beyond that, I think we are waiting for what the U.S. will announce on infrastructure investments. And that's going to be a key driver, I guess, of this year potentially. But in general, what you're seeing is the mood in the market is very, very good. You're seeing the global economy improve, output gaps closing. The big thing that people don't really have on their radar screen is inflation is starting to tick up. I mean, oil has normalized, so what used to be a tailwind for inflation figures that produced lower inflation was the downturn in the oil price. But now, with oil above 70, inflation data are going to come in stronger. Wage growth is going to be stronger in Europe, and wage price dynamics are going to start impacting on inflation. So I think central banks might be, not because they're behind of the curve, but simply by better data coming in, and if that data dependent, might be driven to speeding up somewhat the degree to which they retreat from markets.
But that's the point. I mean, we're talking now about inflation. We probably will be talking about inflation, wage gains in the coming year. Is that going to be the trigger that actually surprises investors? There's a lot of optimism out there. Are people too optimistic?
Yeah, if you look at, for example, volatility is at an all-time low. Complacency and risk-taking is very high in the market, and we've been advising our clients to actually cover their bets because I think with volatility so low and with insurance being available relatively inexpensive, doesn't mean that you don't need insurance. It means you should buy insurance at a reasonable price. And we've been doing that ourselves. We've been recommending it to clients. And I think there are some headwinds that we're going to see this year, despite all the tailwinds the global economy still has. Geopolitical risks clearly still out there. The whole discussion here started by Canada and Mexico, and now the president will come here about NAFTA and what the international trade agreements are. In a world where global exchange of goods and services has been a key driver of growth, undoing some of that or scaling it back will mean that it will impact negatively on growth.
Are you seeing people want to shift their money toward the U.S. because of the tax package?
Well, we're, for example, so we're long U.S. equity and we're long global equity still. We think this is not the time to disengage in equity markets. And since the U.S. profitability and corporate earnings will be so much driven by the tax reform and its impact, you see a lot of investors continuing to have a long position on U.S. equity, and I think that's the right place to be. So yes, globally, there is a strong perception that the U.S. will benefit over the next 2 years over proportionally from this reorientation of policy away from monetary policy only to a more balanced mix between fiscal, monetary, and some structural policies down the road.
Let me ask you about regulation, because the rollback in regulation has been much talked about in the United States. And now we have new people who are running these agencies, but actually the rollback has not hit the banks yet. What kind of a runway are you expecting for the entire industry, given this rollback in regulation, which is quite significant?
It's significant, and it will not just be limited to the United States. There is a long debate now on whether some of the Dodd-Frank rules, some of the Volcker rule implementation, some of the net stable funding ratio arrangements that banks would have to cater for, a fundamental review of the trading book, whether all of that will get embedded into national legislation. Now the focus is, will that global regulatory framework get implemented in national legislation? And that's no longer the Bar Committee. That's, in the U.S., that's politics. That's where basically Capitol Hill will have a big role to play, and the president will have a role.
And so that will take a longer time than people expect, then, is what you're saying?
It's take a longer time, and therefore the need for additional capital raising, for maintaining large capital buffers to to digest some of these developments, is clearly not going to be as much at the forefront of what the guidance from financial institutions will be. We've already seen U.S. banks give guidance that their capital ratios, medium to long term, are not their current ratios, because some of that had been trying to raise capital for potential developments. And we've just recently did that on Monday as well. We said, look, our capital ratio, medium to long term, will be around 13%. And because we have more clarity now, we can't really take it too far, because national implementation of these Basel rules is going to be a key factor on what actual capital requirements will be like. But we expect clarity over the next year on that.
Interesting that the IMF recently raised forecasts for growth for this year and next year across the globe, except for the UK. Interesting that the UK has now become the underperformer of Europe.
And, with Brexit looming, it's pretty clear it's a countdown happening. And we know it will be an event. Brexit will not be a non-event.
There are actually some surprises on the upside in Europe as well. For example, France.
Yeah. Absolutely. And I think the two things that surprised me most this year is how long it actually takes to form a government in Germany, and how that has been inhabiting and, has really not made it possible for Merkel to give strong commitments on the road ahead, whereby Macron, a newly elected president, is now giving long-term visions to Europe. And if you look a year ago, the balance of power between Germany and France in the perception of who drives the European agenda has been the other way around.
Let me ask you about UBS. What do you want to see in terms of changes? Where does the growth come from at UBS in the coming 3 years?
So we've been very clear that given our business model and focus on wealth management and the regions in which we're present, our business will grow twice global GDP. So other than retail banks, who basically move along with the economy, we have a chance of growing much more than the global economy. And that would mean if you have the global economy priced currently at about 4%, 3.9% growth, that could mean our business outgrows that by a wide margin. And that means that our business, in particular in Asia Pacific, will continue to be the driver of profitability. And our U.S. business, given the much better performance of the U.S. Economy, will be a driver of profitability.
Does it surprise you, though, that we're talking about 4% growth, we're talking about all of this optimism, and yet capital markets business continue to be just okay? I mean, when you look at, fixed income trading, trading really under pressure?
It's the point that I said before about volatility. If the market really doesn't see any great risk and isn't pricing risks, that complacency leads to many not buying insurance about risk. There are people that are selling volatility long, and I think that's a very dangerous strategy, because volatility usually, whilst it is low at this point in time, any repricing of the current expected consensus will lead to massive changes in market prices, because everyone's pretty much focused on the same strategy. And as soon as that consensus gets disturbed, people will trade out of the events and market prices will move massively. And so volatility, when it comes back, it will come back with a vengeance.